Hey everyone, welcome back to Corporate Decoder. We're about to dive into LifeVantage Corporation's latest proxy statement. And let's just say there are some interesting nods to how they plan to keep their top executives motivated, which of course means more stock options. Stick around to see how this will play out for shareholders. This filing a proxy statement is essentially a guide to the company's annual meeting of stockholders. Think of it as the agenda and the voting instructions all rolled into one. The big event is happening on the 6th of November 2025, where shareholders will decide on important matters like electing directors and approving executive compensation. So, what is on the ballot? First up, a pretty standard affair. Electing 7 directors. These are the folks who steer the company's ship. The board is recommending all of them, and usually this is a pretty smooth process unless something unusual happens. Now, things get a bit more interesting with Proposal 4. They are asking for approval to add more shares to their long-term incentive plan, basically giving them more stock options and awards to hand out. They're re-looking to add another 400,000 shares and extend the plan, S-Life, for another 5 years, making it run until 2031. Why do they need more? They say it is to attract and keep talented people in a competitive market, especially with new products and global expansion plans. This little maneuver comes with a potential cost to existing shareholders. If this plan is approved, the total potential dilution, which is how much existing shareholders' ownership percentage could shrink due to new stock being issued, could go up from about 18.5% to 21.6%. That is a roughly 3.2% increase in dilution. While they argue it is for long-term growth and talent retention, it is always something investors should watch. When we look at how the top executives are compensated, we see a mix of salary, stock awards, and bonuses. For fiscal year 2025, Stephen R. Fife, the president and chief executive officer, had a total compensation of over $2.8 million. Julie Boyster, the Chief Marketing Officer, earned over $1 million, and Todd Thompson, the Chief Information and Innovation Officer, earned just over $1 million as well. A significant chunk of this compensation comes from stock awards, so their pay is pretty tied to the company's stock performance. Now, there is a specific way the SEC wants companies to report executive pay that can be a bit different from the summary table. For Mr. Fife, the compensation actually paid for 2025 showed up as a whopping $7.4 million. This big jump from his summary compensation is mainly due to how they value outstanding and unvested stock awards at the end of the year. This is a common accounting adjustment, but it definitely makes the pay number look much bigger. Let S look at how that executive pay aligns with the company S performance. In fiscal year 2025, an initial $100 investment in LifeVantage stock would have grown to over $206. That sounds pretty good, showing decent growth in shareholder value. However, their net income for fiscal year 2025 was around $9.8 million. While this is an improvement from the previous 2 years, it is still a relatively small number compared to their executive compensation figures, especially that compensation actually paid number. This spread between executive pay and net income is definitely something to keep an eye on. Even the directors aren't just showing up for the free snacks. Non-employee directors are compensated with monthly retainers and annual equity awards. For fiscal year 2025, directors received around $180,000 in total compensation, with a good portion of that in stock awards. This aligns their interests with shareholders, which is a good governance practice. Looking at who owns the most stock, the numbers as of the 31st of August 2025 show that the Capital Management Corporation holds about 9.84% and Renaissance Technologies LLC holds about 7.01%. Within the management team, Stephen R. Fife, the CEO, holds about 5.61%, and Dayton Judd, a director, holds a significant 6.17%. This shows that key insiders and some large institutional investors are holding substantial stakes. For their auditors, Deloitte and Touch, the fees for fiscal year 2025 were about $650,000. This is largely for the audit of their financial statements. It is important to see that the audit committee is actively involved in overseeing these services. Okay, so let S put all this together. LifeVantage is clearly trying to boost its talent through equity incentives, which is a standard practice. Their stock has shown some decent growth, which is encouraging for shareholders. However, the significant compensation paid to executives, especially when you look at the compensation actually paid numbers adjusted for equity values, compared to the company S net income, does raise a question about how well that pay is truly linked to the company S bottom line profitability. They re-asking for more stock to be available, which means more potential dilution. So it will be crucial for them to demonstrate how this strategy directly translates into increased earnings and shareholder value. Given the competitive landscape they operate in, they're rewalking a fine line between attracting top talent and ensuring responsible capital allocation. Alright, that is our breakdown of LifeVantage's latest filing. What is your take on these numbers and what they signal for the company? Future, did the increase in executive equity awards seem justified? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And make sure you subscribe for more deep dives into corporate filings. And remember, for even more insights and to connect with a community that loves dissecting these reports, check out our Discord server linked in the description. Thanks for watching, and I'll see you next time.